Hey, good morning, everybody. Thank you for making it today on a sunny Monday. We have Jake Haynes here with Action Tax is back again to talk to us today about just what realtors should do about taxes and about everything in between. It's quite a complicated process, I know, for brokers, especially whether they should, stay as a sole proprietor or if they should do an LLC and do an S-CORP and all that kind of fun stuff. Jake is the expert with that, so I will let him take over and give you guys some information and knowledge. And be sure to ask questions. You guys will unmute Zoom people since it's just us here in the classroom. So I will let Jake take it away.
Well, thanks. I appreciate that greatly. Thanks for inviting me. To start out with, I'd definitely like to invite you to go to our website, which is actiontaxteam.com. And we have some great resources there, specifically for real estate agents in our tax section and in other places on the website. We talk about, we give lots of details on the things that I'm going to talk about now for those who like to read up and get more information and detail on it. So it's actiontaxteam.com. And so thank you for having me here today. I greatly appreciate it, Eric.
Yeah, no,
We were
just
just
here.
yeah, we were just saying that it was about 7 years ago, something like that, 6, 7 years ago, that I was at the convention that you had, and we had a few hundred agents there, and in that time, it was a very productive hour. It was very busy, and I kind of said, hey, you know what? I've got an hour. Let's just give you everything. Let's just give you everything you need to know about taxes, because I don't know if I'll necessarily meet any of you here again.
Yeah.
But just go. If you don't work with me, you're going to work with hopefully another CPA, and it will be wonderful to give you some incredible insights to save you a lot of money in taxes.
Mhm.
And I'd love to do that again. Hopefully, I can be a part of a convention coming up soon or something like that.
Yeah, that'd be great to get you back.
Yeah. So to start out with, I want to talk about one of the first most basic things, and that is that you should be an S corporation if you are a real estate agent, if you have a profit in your business of greater than 15,000. Okay. So after when you do your real estate activity, and it doesn't necessarily matter how much you make in gross commissions. What matters is how much you make in profit as an S corp. Okay. But generally speaking, once you're at greater than about 50,000 in gross, then you're going to be at a profit of somewhere around 15,000 or greater. And at that point, in almost all circumstances, you should be an S corporation to save taxes. But that's not always the case. Where it's not a case is if that is your sole source of income and you have no other income except for that as a real estate agent and nothing else, then you likely should not incorporate at 15,000 in profit, okay? Even as much as 20,000 in profit. But anything over 20,000 in profit for everybody, you should be an S corporation. And the reason you should be an S corporation is because the profit on an S corporation is not subject to self-employment tax. So you save 15.3% on your taxes. So let's draw an average scenario here. Let's just say that you make 100,000 in gross commissions. If you make 100,000 in gross commissions, let's say that you make a profit of 60,000. If you make a profit of 60,000 in a sole proprietorship, you're going to pay self-employment tax, 15.3% of right around $9,000. And you're going to pay federal income tax that varies a lot, but let's just say it's about $5,000. So if you're making gross commissions of 100, you're going to pay approximately $14,000 in federal taxes when you file your personal tax return as a sole proprietor. But if you are an S corporation, you're going to save approximately 7,000 to 8,000 in self-employment tax if you are an S corp. So 100%, you should incorporate your business at that point. So when you incorporate it, you don't save all of the self-employment tax, because in an S corporation, you must take a salary as a shareholder in the business. It is required. If you choose to be an S corporation and not take a salary, you are guaranteed to be audited by the IRS. But if you are an S corporation and you take a salary, then all of the rest of the profit is not subject to self-employment tax. And in the case of making about 100K in gross commissions, where you would owe about 16-ish thousand, 15,000 in total taxes, you're going to narrow that down to about 6 or 7,000 in total taxes due. So it's a big savings if you're at that level. And like I say, anything over 15 to max 20,000 profit, you should be an S corporation. So then I get asked a question quite often, should an S corporation be set up for me for like last year? If I'm getting ready to do my taxes, maybe you're late on getting your taxes done, right? And I'm looking at last year, and last year you were not an S corporation. Well, the good news is we can retroactively incorporate you to be an S corporation if you have had profits that you don't want to pay the self-employment tax for up to the previous 3 years. So you can be a corporation up to 2022, 23, and 24's tax returns and carrying on from there. So it is definitely a viable option for people if they have, not filed previous tax returns, because let's just say, you've made a lot of money and you have not yet filed tax returns and you owe, and especially if you have not been making some estimated tax payments to the IRS in lieu of that, right? At least if you incorporate, you can save a very large amount of money, okay? But there are some extra fees for being an S corporation. The first extra fee is that you have to set up the corporation. And in our structure, everyone always asks, what is that? What does that look like? And it can range from anywhere from about 600 to 3,000 to set up a retroactive S corporation. Then your price will vary depending upon some questions that we would ask you. That's the first extra fee, one-time fee. Once you're an S corp, you don't have to do it ever again. Okay. Second fee, you have to do 2 tax returns, not one. You have to do a corporate and a personal return instead of just a personal. So if you had a personal return with let's just say it's a basic simple personal plus your Schedule C for your business, we might charge somewhere in the neighborhood of about $400 to $600 to do a personal return with a Schedule C on it. Your personal return fee is going to go down by about $200 to $300 because you don't have the Schedule C on it, but you must now do a corporate return, which is about $1,000. So you have a corporate and a personal return fee that you will now do year to year to year. So that's an additional fee that you need to consider, right? The third fee is that you have to do payroll in the S corporation, okay? If we're doing payroll for you, we charge you $100 per quarter to file the quarterly payroll reports for you. That's what's needed for officers that do salary, officer salary. If, and you can get payroll done anywhere, right? You can even do it yourself. I don't suggest it, but you can do it anywhere, right? I would not suggest doing payroll yourself. One payroll mistake, and it will have paid for our payroll services for 5 years, right? Pretty much no question, right? One payroll mistake, all the taxes and penalties and fees that you would pay for that would be, and we have a very structured, streamlined process whereby we do officer salary for you, and it's just clean as a whistle, and it's coming, it's there. We structure it, you're set, right? So we do officer salary for about 1,200 real estate agents presently, and it's just in a nice, organized fashion, right? And so you have the S corporation extra payroll that you must do. So that's the third extra fee. The fourth extra fee is very simple. You may be paying it already. It is that you need to renew your entity annually as an LLC with the Secretary of State, which is a fee of about $70. Okay. So there are 4 extra fees to be an S corporation. All right. One is a one-time fee and the other 3 are annually. So annually you have about 2,000 in fees a year that you incur. And let me tell you, if you're saving $6,000 to $7,000 in taxes, just in the first year savings, you have saved money. But then every year after that, you have saved even more money. And if you make more income, you are saving exponentially more dollars by setting up the S corporation. So it is the number one tax strategy that exists for real estate agents, right? It's numero uno. And please, I would encourage you, please ask if if you have questions about that. I'm going to go on to another topic, but I would be happy to answer any questions that you have in relation to being an S corporation. All right.
What about if you're married and normally you're filing as a sole proprietor jointly and you got to separate out your business, anything that you're doing for your 1099 and doing your profit and loss statement, right?
Yeah.
How different is it to switch over from that to to running it fully from an S corp as far as your keeping track of what you spend and
Yes. So it is a process. When you're an S corporation, like you talked about the spending, you want to create a separate entity when you set this up, a separate LLC, which we can do for you, you can do yourself, right? You want to set up a separate bank account for the LLC in the tax ID number that we get you for the corporation. And then you want to segregate that activity 100% between you and your family activities and that business, right? You want to set up a separate LLC, separate corporate bank account for the LLC, and use that only for business activities. If you don't, if you commingle funds and spend from your business account to do personal things, or use your personal and throw it into your business and you're commingling those activities, you lose the value of being an LLC. One of the major values of being a limited liability company is you protect yourself from a lawsuit. Okay. So I have about 1 to 2 agents a year that get sued. And they'll call me up and they'll say, I'm getting sued, and you said if I ever get sued, talk to me. And I'm like, yes, okay, here's what you do. And we have a few steps that you go through, right? One of those steps will likely be that you close the LLC and walk away from the lawsuit. You don't even need to hire an attorney. Okay. But there are circumstances that would dictate whether you would do that or not. But that is the advantage of being an LLC. Literally, you can close the bank account, close the LLC, and walk away from this lawsuit, right? And they cannot touch you. I have personally done it many years ago. I had an LLC and I was sued, and I literally just called opposing counsel and said, I have an LLC, I have closed it, and I am walking away. Thank you and goodbye. And that's just as easy as that, right? It can save you many thousands of dollars, right? So that limited liability is the second advantage for being a corporation. But if you commingle funds, what the attorney can do at the time that you say, I'm an LLC and I'm closing my company and I'm walking away, they can say, no problem. Send me all of the bank records. So you then are required to send the bank records to this opposing counsel attorney. That attorney goes through your records and he looks at 2 things. First of all, he's looking for commingling. If he finds out that you commingle activities, you just canceled your LLC value and you're going to have to fight the lawsuit because you're going to be sued personally. The second thing that they're going to look at is what was the balance on the bank account at the day that you got sued, which was 1 week before you knew you got sued. Okay. They sued you, and then 5 days later to a week later, they handed you the paper and said, you're being served, right? So between that time in your bank account, if you're holding on to $200,000, whatever it is, they can say at that point, the opposing counsel can literally call you back and say, no problem. Write me a check for $137,219 that you had on your bank account that the day that we sued you, and we're done. We will gladly walk away. And that's your obligation, or to fight the suit at that point. So the second advice that I give in relation to being an S corp is that you have a minimum balance in the bank account at any given time. Carry enough in your business bank account to cover like maybe a couple of months of expenses, and that's it, right? No more. Keep a minimum balance in there. Then if you do get sued, literally, if it's $2,000 or $3,000, what's going to happen, or 15,000 even, that opposing counsel attorney is going to talk to their client and say, okay, there's 10 or 15,000 in this account, and he's closed the LLC. So unless you're going to pay me 50,000 to represent you, I'm not even starting this lawsuit, right? So that's the way that'll work, and that's the way you want to structure it, and that's the controls that you'll want to have, okay? So then I explained to agents, when you are an S corporation LLC and you are keeping separate sets of books, you should have a bank account for the business under the corporate tax ID number that you get when you set up the corporation. And then if you use a credit card, either a corporate credit card, or you use one of your personal credit cards and you put it into the business and use it exclusively from that point forward for business only. All right. So you don't commingle the activities with a credit card either. You say, this is a business credit card, never to be used for personal. And then you have a personal credit card. All right. So then there's a few things that come in relation to that, like, I'm out eating and what do? Is it a business or is it a personal? All right. Now, the IRS has their own opinion on that, and their opinion kind of tends to rule if you get audited. But generally speaking, what I say to real estate agents as we work for is that you should select a cutoff time. Okay. What you should do is you say, okay, from 6 o'clock prior every day, it is a business expense, no matter whether it's business or personal. At 6:01 on every day, no matter if I'm doing business or personal, I will use personal only. So you have segregated the clock, right? You said, okay, doesn't matter. We're going to pick a time. Anything before is business, anything after is non-business, right? If you do that process, okay, and you get audited by the IRS, right? And the IRS says, what is this meals expense that's large? First of all, I'm going to look at it's going to be reasonable and it's not going to get you in trouble. But if you're getting audited and they shoot and they see 2, 3, 4, 5, 7, 8, 10,000 in meals, right? And they think, well, that's not even close to reasonable. This is what we're going to say. We're going to look at the books and we're going to say, okay, you have 7,000 in meals expense that are on the business. All right. And they're going to say, yeah, that's not reasonable. I need lots of receipts verification. And we're going to get that. We're going to have, credit card statements and all kinds of things that show that. But then we're also going to say, I want you to look at something here. After I also have another 7,000 or 9,000 in personal meals and expenses, right? Personal meals activity. But here I have 7,000. So I have split that between what is business and what is personal. And that's your reasonableness test, right? Is it reasonable? Can the IRS say, okay, all right, we will justify 7,000 in meals. If you make, 750,000 as a real estate agent, 7,000 in meals is reasonable. If you make 100,000 in real estate income, 7,000 will be a guaranteed audit. You are getting audited. There is no question, right? Mm-hmm. So we just do the reasonable, right? What is reasonable? And we take that and look at that. So that's just one of the areas, right? We want to be reasonable in all of the expenses as a business, right? So there's another great write-off for S corporations. And if you're working with another real estate or tax person, you positively need to do this. Make sure that they give this to you. Some do and some don't. I don't know why they don't. But it is to take a home office allocation for business use of home. When you're a sole proprietorship, they do this thing called the home office deduction, and it's called that on a Schedule C, okay? The United States believes that gets you audited. The reason that they think that gets you audited is because about 30 years ago, the IRS audited 2,000 companies on a test audit to determine if the home office deduction was reasonable or not. And what they found from the conclusion of that is, yes, it's reasonable. Yes, we will allow the deduction. But now the world thinks that you get audited from it. You don't get audited from it. Every person should take it. There is no question about it, right? Sole proprietorship, take it. And an S corporation, though, what do? In the eyes of the IRS, you have the corporation and you have you. And they are two separate entities now when you are a corporation, okay? So it would be very similar to if I said, Eric, can I conduct business in your home? And Eric would say, okay, you're going to pay me $1,000 a month in rent. And I'd say, okay, there's $12,000 for the year. And my corporation has a $12,000 write-on for rent expense. Okay. Now on Eric's personal return, if this was Eric, right? Eric's on his business just paid him $12,000. And on Eric's personal return, he would technically recognize $12,000 in rental income. Okay, so you got a $12,000 write-off on the corporate return. You just decrease your bill by $3,000 to $4,000. Okay. On your personal return, you have 12,000 in rental income. And when you take a portion of your mortgage interest and property taxes and utilities and depreciation and other things on your house, you bring that down to no taxable profit. So the question is, what can we give you on your corporate return to which when we put it on your personal return, you have zero profit? And that's the magic number. That's what we give you as rent expense on your corporation. It can be a pretty dramatic write-off for different parties, right? That's a big write-off. And one big advantage to being an S corporation is compared to what they did about 5 years ago with or 8 years ago in 2018 with the changes on the IRS code is they said, we're going to do this thing called a standard deduction for an escrow for a home office deduction of $1,500. So in a Schedule C, you basically get free of charge. No questions asked. You get a $1,500 write-off on your profit on a Schedule C. All right. So that's what you get in a Schedule C. In an S corporation, it could be 6, 8, 10, 12, $15,000. It could be more. It would depending upon multiple variables that we determine at the time that we file the return. All right. Now you must take a reasonable salary. So there are going to be some people who are hearing this that are already an S corporation. Okay. The biggest savings that you have in an S corporation, if you are already an S corporation that we can talk about today, will be what are you taking as a salary in the S corporation? All right. So if you have a profit, let's say, of 100,000, okay, let's just say you have maybe whatever, 200,000 in gross revenue, but you have a profit of 100,000. When you have that profit of 100,000, my suggestion is going to be that you take 1/3 of that profit in the form of salary, or 33,000 in salary. All right. On that 33,000, you're going to pay about 6,000 in self-employment tax, and you're going to save, you're going to save about 10 to 11,000 in payroll taxes in that scenario. All right. And if you are an S corporation and you are right now taking a salary of 80,000 and you have a grand total profit of 100 and you're taking 80 of it in the form of salary, you're giving the IRS an extra $7,500 that you do not need to give them. Dang. Right? So that is probably the number one thing to know. And that's about, planning, right? We plan that, we take it appropriately. Now, a lot of people say, well, then how do I get paid? I need to take a salary, right? You get paid in two ways in S corporation. You get paid first from the profit and the wage that you take. So if you take a $33,000 salary, you get your net paycheck out of that. But then you get all of the rest of the profit in the business is yours to draw at any time you want, not subject to self-employment tax, right? Okay, so then we go on. You take a $33,000 salary, okay, but you have a total of 100,000 in profit. 33 is salary, 67 is the rest of the profit. And in an S corporation, the profit passes through to the shareholder on their personal tax return. The S corporation itself pays no federal income taxes. It's called a pass-through entity. All right. So the corporation pays no tax. The profit passes through onto your personal tax return. So on your personal tax return, you'd have wages of 33, profit from an S corporation of 67, and then you might have all your other income and deductions. You might be married and have other stuff, and other income from spouse, all kinds of stuff going on, right? But ultimately, you have $100,000 that you're going to get taxed on. And so you're looking at that saying, how much tax liability does that produce from my side of the equation as one of the shareholders, right? So when you look at that, you're making $100,000 of profit. That's where we do some tax planning. Okay, so we determined that you're going to take a $33,000 salary in your S corporation, and then you're going to have a profit of 100. And let's just say that that's going to produce 15,000 in federal income taxes due. All right. So we are going to give you a salary of 33,000, and we're going to withhold 15,000 in federal income taxes from that payroll. All right. So you're not going to have to worry about making estimated tax payments like you would normally, or worry about, are you going to owe at the end of the year because of the profit that you made? We're going to predetermine what that is, and we're gonna reconcile it and make sure we're good at the end of the year and give you the appropriate salary and withhold the appropriate potential extra federal income taxes. So that when you go and do your tax return at the end of the year and you have your wages of 33 and your husband's wages of 80,000 and your other income of 25,000 and your profit on your S corporation 67,000, and then you take your standard deduction and you take your children's deduction and you take this tax credit that you have, and ultimately you owe like 15,000 in federal income taxes. You paid in 15,000 through payroll and you break even. And that's the plan when we file the return, right? So some really good, smart tax planning, a really effective tax salary as a shareholder, right? The appropriate amount ultimately saves you in many different ways, right? No penalties when you file because you didn't underpay. Taking the appropriate salary, not paying a lot of extra payroll taxes, and not paying any federal income taxes so you don't need to, getting extra write-offs for the rental of your S corporation. So there's a lot of things there. All right, if there's no questions about that,
Definitely got a question.
okay, great.
Quarterly, so no quarterly payments?
Yes,
Or-
you do make quarterly payments
Okay.
through payroll.
Oh, through payroll.
We
Okay,
execute those
Yeah.
rather than you need to make separate quarterly estimated tax payments, to which you got to remember to do,
Mhm.
right? And we preset that. So if we're giving you a salary of 33 and we're withholding 15,000 federal income taxes, that's like a total bill of about $22,000. So what we do is we stretch that out to be made throughout the year. And we actually do some specific tax planning with you where we say, you know what? Eric, during the months of June, July, August, September, and maybe even October, you make most of your money, right? So what we're going to do is during the months of June, July, August, September, and October, we're going to do all of the tax payments for you, right? We're just going to bang, 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 bang. You paid all your taxes, right? And then in October, November, December, or whatever, January, February, right? You don't have to worry about taxes. You already paid them in full, right? So we do some specific tax planning with you that we predetermine exactly how, when, and where we're going to pay those taxes, right? And we pay the appropriate amount. We do all the planning appropriately for you so that by the time it's slow season, and you're like, oh my gosh, it's March and I haven't had a single sale and I have to file my tax return and I owe 15,000. No, you're going to be coming in March and you're going to have long ago paid those taxes in June, July, August, September, October of last year. You're going to come in, you're going to walk in, you're going to be like, oh, great, I got a refund of $700. Wonderful, right? Or, oh, I owe $300. Okay, great, no penalty. I just owe, yeah, this is perfect, right? You're in a sweet spot. You're in a good condition. You're not like sweating when you come in to get the taxes done, right? It's not a miserable experience. It's a, hey, you know what? I just got it. That's just one more thing I gotta get done, right? Okay, an S corporation is due by March 15th of each year. Okay, not April. So a corporate return is due by March 15th. The idea is that if you have multiple shareholders in your S corporation and you get your return done by March 15th and you find out what the profit is, then you can get this profit information to the shareholders to get their personal return done by April 15th. So you got to remember that if you're doing corporate return. So if you're working with us and you're the only shareholder and you got your real estate business and you got a profit and you're worried about getting those taxes done by March 15th, but you can't get in by March 15th, don't worry. Without your permission, knowledge, or information, or worry, concern, or anything, we file an extension for you on the corporate return automatically. No questions asked, right? You don't even need to know it's happening, right? We get that extension filed. If you don't file the extension on a corporate return, you don't owe corporate taxes because the profit passes through to your personal return, right? So the IRS can't penalize you on the taxes you didn't pay for not filing by March 15th. So what they do instead is they say, for a pass-through entity, if you do not file by March 15th or get an extension filed by March 15th, we penalize you $200 per month per shareholder. That's the way they do it. So we file that extension for you automatically, all right? And then you just need to get in by April 15th. Now, if you can't get in by April 15th and you have done payroll with us and you know you're good, no problem. We file an extension. If you haven't done the appropriate tax deposits, we'll have a quick phone call. Okay, where are you going to stand? All right, we're going to make a tax deposit of $2,000 and then we're going to put you on extension and you're good. We can get it done by September and October 15th. We can stretch this out. We're good, right? So just all of the appropriate planning when you're working with a team that, we know what we're doing. We do our job the way we're supposed to, and you do your job right. We're streamlined. It's clean. It's a sweet situation to be in it. Having just things taken care of for you and knowing you're not just needlessly paying penalties, right? We share in that responsibility, of course, right? You do your part, we do our part. You give us permission to make those tax deposits for you, right? We do this in a structured format. Okay, enough about S corporations. I want to talk about flips. No, let's talk first about one that people like to know a little bit about, and that is doing a cost segregation analysis.
Yeah.
Cost seg analysis is a big topic today, but it was bigger when the real estate market was super hot. Now, right now, it's not super hot, but it is okay. And the Airbnbs, the whole short-term rental market has definitely lessened, right? Since the COVID era and things like that, it has lessened. So a cost, but having an Airbnb, I explain to my clients. Now, I have a lot of clients that are like Microsoft execs and Boeing execs, not necessarily execs, but they make a lot of money. Okay, so they're making 2, 3, 4, 6, 8, $1 million, right, a year in revenue. And I explain to these individuals the number one tax strategy that exists for you is buying an Airbnb. It is number one by a long shot. Okay, and here's how it works. They go and they buy, let's just say like a property over in Lake Tapps. Okay, and it's a great Airbnb property, and they Airbnb it out. And when they do that, let's just say they paid $2 million for the property. All right. So they have an Airbnb over there, and I explain to them, go buy it and go get it rented before the end of the year. You must have rental income in order for it to be declared as a rental. All right. So they get it bought, they get it rented, they make whatever 2,000 or 100,000 in rental income, whatever it might be, and they come in and they get their taxes done. When they get their taxes done, they've got a $2 million property that they get to do a cost segregation analysis on. And what that does is it says, of the 2 million that you bought the house for, there is about roughly 20% of that they can immediately write off the first year when they get a cost seg analysis done. So that equates to $400,000. All right. So when they get this tax return done and they have 100,000 in rental income and they have all of these expenses for getting it set up, and they're basically sitting at about zero profit, right? But then they get a $400,000 bonus depreciation. So now they're at negative 400,000, and they are a Microsoft employee, an Amazon employee, and they make $700,000 in income. And then they take a loss on that. They're now down at 300,000 of taxable income. They just saved about $70,000 in taxes, right? Just like that. Wow. Okay. So they get the cost seg analysis done. Now there's this terrible advantage that you real estate agents have that none of the rest of us have, where you get to take advantage of real estate losses no matter what your situation is. When you have rental properties and you have a loss on the rental, which almost all rentals are like that on paper, on tax paper, you get to take advantage of a rental loss. But a person that works for Amazon that makes $700,000 a year and they show a loss on the rental on a normal long-term rental, they do not get to take advantage of the loss. They are limited. They have zero. If they have a profit, they have to pay taxes. If they have a loss, they literally do not get to take advantage of it. It's really a stupid ass rule. Sorry. That's okay. All right. So they don't get to take advantage of it, but you as real estate agents do. So you buy a property and you do a cost seg on it and you do it as a long-term rental, you're going to get the bonus depreciation. And it is the number one tax strategy that exists for you. Non-real estate professional does it, and they must do short-term rental. They must do it the first year anyway as an Airbnb type rental. Now they've got it as short-term rental. because the IRS made a classification ruling 2 or 3 years ago that said that a short-term rental is more active participation than a long-term rental is. And so we're going to classify it, you could put it on a Schedule C for self-employment rather than on a Schedule E for rental where you don't get to take advantage of the losses. So you're over here as a Schedule C, you get to take advantage of the loss on a Schedule C. So now the person who made $700,000, they get to take the $400,000 first year loss. They're saving like $75,000 or whatever that figure might be, right? Number one tax strategy that exists. So if you have clients, if you have situations where people are high income, tell them, this is what you got to do. I got to get you an Airbnb. I got to get it right away. We got to get that thing bought and we got to get it rented out. We got to get it filled, with furniture and everything. Number one tax strategy. If you have any clients like that, send them a specific special email and then a phone call and then a text, right? And follow up with them like crazy and say, I want to help you save a lot of money this year on taxes, right? Good strategy, right? You'll end up selling a few of those to a few of those customers. So that is a great strategy. The short-term rental cost segregation analysis for you as real estate agents, anything. If a married couple makes less than $180,000, then they get to take advantage of losses on real estate. So it could be beneficial for them either way. But once they're over that figure, they don't get to take advantage of their losses anymore. So they want to do short-term rental. So if someone says, I don't want to do short-term rental. I want this to be a good, reliable, long-term rental contract. Tell them, beg them, plead with them for their sake, for their tax purposes. Do the Airbnb just for a few months and get that income in that format. We will do the cost segregation that first year, then convert it to long-term rental, carry it for years, right? For years after they got the huge write-off. Okay, so the tax strategy that exists now with about probably 150 of my clients is every year they are buying a new short-term rental. And every year it's going on like 3-4 years now, and it will go on for like 10 years. They will be buying another one and another one and another one in the first year doing short-term rental and maybe long-term, but short-term for years. But if they convert it to long-term, no problem. But they're just doing a short-term rental, purchase for the next 10 years. And for the next 10 years, they're nearly paying no taxes to the IRS. It is a beautiful thing when you're making $400,000, $600,000, $900,000 in income and you have no tax bill. Beautiful.
Is there a good way to set that up on something that maybe is a little bit run down and then you do the cost segregation and then fix it up? Is there a benefit to doing it that way?
It doesn't really matter.
Or does that not matter?
Yeah, it doesn't matter. And that the nice thing is if you put 200,000 into the remodel or whatever, that is going to be added to your cost, to which you will determine and be able to get a bigger initial write-off. Yeah. And so that, you're required to write that up over a long period of time, but it just depending upon the whole picture, when they do the cost seg analysis, you can get that advantage. Now, we actually work with a company that does cost seg analysis that I have made a deal with. And this company, normally a cost seg analysis costs about 3,000 to 6,000, sometimes more when it's a commercial property or it has a multi-unit apartment complex, right? So it can be pretty expensive. The tax savings way outweighs it, but it can be pretty expensive to do it, right? So what we did is we communicated with the company, and I was at a conference and I ran into this company, and they have locations for literally all over the United States. And I said, so I do these cost segs, and I want to I'm looking to get a very good deal from someone to do these cost segs, and I'm going to give them probably about 100 to 150 every year. And they're like, well, we're on it. And they came back and they charge us $2,500 to do a cost seg analysis. And so I think that is the best price that exists out there. If you guys find something better, great, wonderful, use it. Please tell me about it. I want to know. I want to tell all my clients to use it, right? But I think that is the number one out there that exists is $2,500. They're giving us a good price, right? Now I have to work with them a little bit on it. So I made an agreement. I said, I will get the application filled out. I'll get the documentation from you, the person who bought the property. I'll get that in, and then we'll submit it over to them. They'll get it done. They'll send everything back to both of us, and then we'll do the tax return with the cost seg on it. But that's how, I had to give a little bit. I'm like, that works really well for us because we have lots of clients that need that. And this is going to be a huge tax break for many, many, many people. And we'll help you get that organized. And we know you're giving us a very good price for it. So
What's the name of the company?
West, shoot, I can't remember, West something. Do you remember what that is? Yeah, I don't remember who it is, but it's West something. But literally, I just send you an application and you fill it out and we get going. We get started on it. So you don't need to be my client to do that. If you want to get a cost seg analysis done for whatever purpose, just shoot us an email and we'll get you started on it. Now you could reach me at Haynes, JHANES at actiontaxteam.com for any of these purposes, right? You can reach me. I will likely put you right in touch with my assistant and she'll get you whatever you need. If you need an application for a cost seg or if you need a tax appointment to talk about the S corporation strategy, any of the above. Okay, I want to do some Spitfire, kind of other things. Does that work?
Yeah.
All right, so let's see here. I have right now about 50 customers or more that are flippers, right? They do flip projects and they do anywhere from 1 to 2 to 10 a year. And so I personally, like right now, I've got 4 properties out that I am flipping right now. So I'm very familiar with it. We have a team of investors, real estate agents, and construction companies. I have a very big team and network, and we have a machine going, and it works very well for doing the cost segs. And so I actually do training on flipping, and we do coaching on flipping, and we talk a lot about the tax strategies of flipping. There is one major component to the tax flipping that is critical. So if I'm not doing your tax return, you got to tell the people who are doing your tax return to be sure to capture the overhead costs as part of your cost basis on your property on each flip that you do. That's the major thing, okay? When we do a cost, I have on my website, if you go to the actiontaxteam.com website and look down at the very bottom of the front page, there are a whole bunch of different kinds of organizers, and one of them is a flipper organizer, okay? And that flipper organizer is perfect. Build that in and you have everything that we need or your CPA needs to do a flip, all right? What we want to make sure in a flip is we want to make sure it can capture 100% of all costs associated with that flip to minimize your gain. And that worksheet helps you do that. All right, it's a clean tool to get you to the point where a flip can be not, can have the minimal tax impact. Of course, if you hold the flip for more than a year, you're eligible for a 1031 exchange. 1031 exchange is a great strategy for a flip, right? And there's other rules. There's lots of rules about 1031s on my website. I have a whole page dedicated to questions and answers about a 1031 exchange. And many I'll refer many to that often because it's a great tool that just answers just all your really basic questions about it. We know that 1031 exchanges have opened up to include more things now than what they used to. So you are more likely to be able to do a 1031 exchange. All right. So you can check that out. Let's see here. There are some tax credits that are available that the reality with the tax credits and tax deductions, the tax rates right now is everything is about to change. We know that sometime in the next 2 or 3 months that hopefully there's going to be the big beautiful bill or one big beautiful bill or whatever they call that they're putting through there that's just got all kinds of politics and all kinds of stuff surrounding it. But ultimately, we're going to get something passed, right? And hopefully we're going to renew the 2018 tax cuts that took place that gave most individuals about a 5 to 15% reduction in federal taxes due. We hope that that's actually going to increase, right? So there's some questions that I really can't answer right now about what's going to be available, but we will know soon. So once the new tax laws are enacted, I'll be doing a webinar, and on that webinar, I will talk about that in specifics, and we will find out with all of our clients, we'll find out specifically, well, how can we take advantage of it before the end of the year? What can we do? Because I think there's going to be some good things in that package, be it for individuals, for small business, for big business, whatever it is. I think there's going to be some good tax strategies in there that if we plan for it this year, you can lower your tax bill quite a bit. But generally speaking, there's things like the solar tax credit if you want solar that you can get. There's the electric car credit right now that you can get, right? There's there's the business, qualified business income deduction that every business owner should get. The fact is that 20% of your profit on your business, you should not be taxed on. So there is a very specific strategy to getting the most out of that. Okay, and here's how it works. If you have a profit of $100,000, 20,000 of it is not taxable, right? In your business because of the qualified business income deduction. So if you take a salary of 80K and then only show a profit of 20, your profit on your business is 20, and you only get a $4,000 not taxable qualified business income deduction. But if your profit is 70, you get 28,000 of it non-taxable. So why do we take a smaller salary? That's another reason, right? So don't take a big salary, okay? There is planning around that, okay? But here is one reason to take a potentially slightly larger salary, okay? And that is that depending upon the salary you make, you may be able to make a larger contribution to a 401k. All right. So that is a very good tax strategy, is to set up your own 401k, which is called an owner K. All right. When you're a real estate agent and you're basically self-employed and you are the owner of that business, and you and maybe even one partner, it doesn't matter your partners, but you don't have employees, you get to take advantage of what's called an owner K. It's a very inexpensive option to do a 401k for you yourself. Okay. So if you take with a 401k, the business gets to make an enormous contribution to your 401k, and you get to take a payroll deduction to contribute to your 401k. So you can contribute easily 40, 60, 80,000 to your 401k every year. So if you have a lot of income, if you're in 800,000 of profit, right? Well, the one thing we're positively going to do is take the appropriate larger salary to be able to contribute a lot more to your 401k, which is a direct deduction on your taxable income, and balance that with the profit gets a 20% qualified business income deduction. So 20% of the profit is not taxable. So we find the magic number. What is the best salary to be at to get the maximum contribution, but ultimately the best tax benefit? And there's process to that. I'm talking a lot of detail. Yeah, there's a lot of detail, but I just got it's really important that you get good tax planning when it comes to that stuff, right? If you get the right tax planning and you make the right decisions, oh my goodness, I hate giving the IRS money. All right. I think we all pretty much dislike that. That's actually my philosophy. My philosophy is we will bend every rule with the IRS. We will not break any rules, but we will bend the rules with the IRS and get the maximum possible tax benefit that we can get. All right. And then this is a tax strategy that we get into a lot of detail on and find out which is the best way to go on it to get you the best tax situation. Okay. All right. So there are some other, there's some investment opportunities right now that exist. Like I explain to people that your number one tax strategy is to do the cost segregation analysis and to buy a short-term rental, if that's the case, right? Another tax strategy that exists is to invest in property or invest in investments to which you don't get the taxable income now, but you get it maybe after a few years. Okay. So like I'm in an investment right now where there's $100 million going into a 40-acre project on Kona Island, in Kona on the big island of Hawaii, right? So on this rare earth, they are building about 150 units, some small bungalows up top and some middle-sized houses and then some mansions on the bottom, right? And in this project, you're getting there's a gain that you're getting if you invest in the project, but the gain is not coming until the end. So you invest now, and maybe in a few years you will have a taxable benefit. And at that time, you can actually avoid that taxes if you do some specific things. But it's income to which you can postpone the recognition of income. Then we have about 1, 2, 3, 4, 5, 6, 7. We have about 7 investment opportunities that we can discuss about. What could you do that you wouldn't necessarily, recognize taxable income right now at this point? All right, let's see here. Salaries, officers in an S corporation. Going back to that idea. If you're doing your own payroll, know that you are not subject to L&I and unemployment. You are an exempt officer. So don't be paying that on yourself. Okay. All right. Another tax strategy that exists. Actually, it doesn't quite apply in this setting. But it applies for more clients that are not real estate professionals. Let's see here. Make sure to take advantage of every write-off in your business, right? So we have a spreadsheet, we have an organizer called a real estate organizer on our website. And that real estate organizer is a superb one-page summary document. Fill out that one page and we have every expense that a real estate agent could possibly have, that we make sure and capture everything, right? Use the real estate organizer, no matter where you're going to get your taxes done. Of course, we'd love to have you. We'd love to have you, but we know that many of you work with someone great and you're very happy with that. All right, employer benefits is something that you want to look at. So what benefits can you as the employer and owner of the S corporation take advantage of that maybe others could not, right? So as for instance, if you're getting healthcare on the healthcare exchange, all right, just because your circumstances, you're self-employed or otherwise, a spouse doesn't happen to have health insurance. And so you're getting it through the healthcare exchange or you're buying it out of pocket. That is a very specific process by which we record on your payroll and we get to take a business expense on. So let's be sure to calculate that is thousands of dollars, right? We talked about the home office deduction. Okay, another strategy. If you are an S corporation and you have if you basically, the reality is if you're in the 22% tax bracket or higher, you should do this, okay? In other words, if your combined taxable income is greater than about the taxable income is greater than about 78,000, I think is what it is, at least at this point. It'll change with the new tax law, I'm sure, but whatever, if you're about that or more. So if you have $200,000 or $300,000 of taxable income and you're taxed at the 22, 24, 32% tax brackets, do this strategy. Okay, you're an S corporation, you're taking a payroll, small, reasonable salary, right? Put your children on payroll. Okay, every one of your children needs to be on payroll. Here's why. The standard deduction if your child files a tax return is $15,000 or thereabouts. Okay, so if they do a payroll of $15,000 and they would technically do a personal tax return then, and they have a standard deduction of $15,000, they owe no federal income taxes, right? So you take a payroll for them and you don't withhold any federal income taxes from them. Okay, when you did their payroll, you paid approximately $1,800 in payroll taxes to give them a salary of $15,000. They do a federal income tax return, no taxes due. It's wonderful. Okay, on the side of the business takes a deduction of $15,000 for the payroll, and then it takes a deduction of a couple few thousand for the payroll tax expense. And when you take that deduction, which is about, let's say, 18,000 at your tax rate, you're saving about 36 to 4,000 in federal income taxes. So you pay about 1,800 in payroll taxes to save 4,000 in federal income taxes. Great strategy, right? Okay, add to that. Now you've got them on a payroll. If you have a 401k set up and they are considered an officer in the S corporation, which they need to be if they do give them a payroll, you can actually give them a 401k. You can start funding your child's 401k now. And it's a deduction. It's a write-off. They don't even need to know it, and you don't want to tell them, or they're going to try to take the money, right? But you just start giving them a full payroll and contribute a bunch to their 401k, and boom, 6, 8, 10, 15 years later, they graduate from high school or college, whatever, and you're like, oh yeah, by the way, I have 150,000 in a 401k for you now. You know, you might not want to tell them until they're about 30 because they'll still try to draw it out early. But but anyway, it is a dynamic strategy. So not only could you do a 401k for them, but you can also, excuse me, you could do a Roth, but it's a specific kind of Roth. It is a uh it's like an advisor plan. You administer the Roth plan. So you could start contributing to the Roth, and it's a business expense when you contribute to the employee's Roth, which just happens to be on your S corporation as an employee, your child, right? So a great strategy, right? Contribute, max their Roth out every year. Well, I almost have the name of it. Anyway, it's a specific kind of Roth, okay? So, and so when you do this Roth or this 401k, right now you're adding to your write-off, okay? You're getting another $1,500 in tax benefit just by doing that, okay? So a great strategy, put your children on payroll. There's a specific way to do it, and you want to be smart because you don't want to have them incur federal taxable income when you do it, because then you lose the tax benefit of it. All right. Let's see here. So bookkeeping and payroll and adequate record keeping, right? Keep everything, keep everything, keep every record, keep every single receipt, keep every record all the time, everywhere, no matter what you do when you're on the business side of things. Keep every record. All right. And here's how easy it is. Get an app on your phone that takes a picture of receipts. Boom, done, right? You get audited, you literally have a report to give to us to help you with that audit, right? If you're with us and you're our client and you buy the Audit Guard insurance, we represent you at no cost. All right, we're going to represent you in an audit, and it will be a fairly clean audit, right? We don't need to worry about an audit, right? But if you do happen to get audited, right, keep good records by just taking the pictures of everything, right? You do bookkeeping, my suggestion, any business, any real estate agent over 150,000 in gross commission should be doing full service bookkeeping. That's my suggestion. All right. Once you're over 150,000, you just simply have too many transactions going through your bank account, and you should get bookkeeping done at that point. All right. Under 150,000 or so, right? Anything under that, then literally you could just fill out my real estate organizer. And so if you have a LLC, S corporation, whatever, if you have 12 bank statements from a bank account, and if you have 12 statements from a credit card account, you could go through 24 statements, and in in a partial day, you can fill in a worksheet, and we'd have everything we need to do the tax return. Absolutely every single deduction would be on those two sets of documents, right? That's a clean set of books right there, right? Don't do cash activity because it's very, very hard to track cash. But if you do cash activity and it's a business, you positively take pictures of receipts and records, okay? Everything you can get for record keeping. The IRS is nasty when it comes to not giving write-offs because you have no receipts and no paperwork, right? And if the receipts can be faded when they come in for an audit just a few years later, they could be messy. So if you just simply make it a habit, take a picture of it, right? It's a great thing. Okay, another piece of advice, using your phone. Get an app that tracks miles. It's super convenient and easy, right? I'm actually in the process of potentially creating an app that's going to be free for real estate agents that will track miles. I'm hoping to get that eventually, and if I have it, I'll let the world know, and we'll make it available to everyone. But right now, you can pay for a couple of options for an app. Mile IQ is a great one, and there are a couple others in there. There's one that's less expensive. I wish I had notes. I don't have notes on that, but just look up apps that track miles, and it's super easy. And when you come in and you're like, hey, I've got 16,321 miles, I'm like, perfect. We have a perfect record of just your business miles from the app. Okay. So positively keep those, track of that. That's a biggie. And that is a big write-off, by the way. Should you do actual expenses, or should you do miles when you are a real estate agent? Miles. Okay. Do miles. I get asked that question a lot. I want to buy an SUV and it's 6,000 pounds and it's going to cost me $80,000, and I want to be able to write off my business and have no taxable income. Miles. Really? really miles. Let's just say you buy the vehicle for $80,000, okay? And you're not gonna write off 100% of it. That's an IRS audit with a vehicle writing off 100%. When you only have one vehicle to real estate business and writing it off, that's an IRS audit. We won't do it. But we might write off, let's say 80% of it, right? So now on that 80,000 vehicle, let's just say we're getting 60,000 of write-off, okay? So first year, you get $60,000 of write-off and it's fabulous. Okay, 1 year, fabulous. Okay, the next year you get about $3,000 of fuel and repairs expenses. Another year, 3,000, another year, oh, you had a little bit of repair, so you have $4,000 in expenses, right? So you have these little write-offs that you get, 3 or 4 times, and then you trade the vehicle in. And for this $80,000 vehicle that you bought, let's say you trade it in for $50,000. That'd be reasonable, right? You get this nice, beautiful SUV and you trade it for $50,000. You wrote that vehicle off as a business asset. And now you are selling it for $50,000 as a business asset, and that is a $50,000 capital gain. So you in net got nearly zero tax benefit for that write-off, right? You just gave it all back to the IRS a few years later. But if you do miles, then you have 20,000, 2,100, 22,000, 18,000, 19,000 miles. That write-off includes depreciation, it includes the mileage allowance, it includes the gas expenses, it includes the repairs expenses. So it's a big write-off right now that's 67 cents a mile, right? And so you get like a 10 to 15, $20,000 write-off year after year after year after year after year after year. And then you trade it in, doesn't matter. You trade it in, there's nothing to worry about. You make 50,000 on the sale, no taxable income, right? But if you write it off, you have to recapture. Recapture the tax is not a good deal, okay? All right.
That definitely makes sense.
So I fired through a whole lot of ideas. If any of you have any questions or other thoughts or things you want to ask, feel free to pipe in and I'd be glad to answer those questions. And I'll look through my notes here and see if we have any other great little tidbits.
Zoom people, anybody have questions? Feel free to unmute.
Okay. All right. I think I.
Jake's awesome.
Hey, Deep, nice to talk. Nice to see you. Twice, man.
I've been a client for many years and he definitely does not disappoint. Every time I go in there, I learn something new and he's great. I've sent him people, sent him clients, and he always takes care of them.
Great.
Definitely appreciate the referrals, Deep, and there have been several referrals, and we're definitely helping a few of them out. I'm thinking of one right now that we are helping out in a big way. It's good. Thanks for the referral. Appreciate that.
That's awesome. Well, all right, you guys, thank you so much today for coming in. Sorry we didn't get to in-person people. We got more virtual, but it is the time of year for kids to get out of school. So we appreciate you guys coming in and hopping online, but we will put this out on our Facebook, on our YouTube channel, and then also social media. We'll be sending it out. But thank you so much again for coming in, Jay, and we will see you soon, I'm sure. Yeah.
All right.
Take care, guys.
Thank you.
Thank you.